Right, Canadian inflation ticked higher in August, but is the door still open for the Bank of Canada to cut interest rates at tomorrow's meeting? Joining us now to discuss is Robert Both, Senior Macro Strategist with TD Securities. And Robert, thanks for joining us.
Thank you, Anthony. My pleasure to be back on the program.
All right, so we got the headline news. What's the reaction to this morning's CPI report?
So the CPI numbers were a little bit softer than the market expected. We knew inflation was going to move higher. A lot of that was just the contribution from gasoline prices. They were putting a lot of downward pressure on inflation in July. Some of that has come off in August. But the headline number was roughly in line with our forecast. We thought we would get a small move higher to 1.8. It was about 1.85%. But we did see in that report a little more downward pressure on core goods. So you're not necessarily seeing those tariff impacts feed through goods prices. We saw a little bit more progress on the Bank of Canada's core inflation measures, and overall just a little more stabilization across the inflation backdrop. So, very important number. The Bank of Canada has been very preoccupied with inflation data. It's coming right on the doorstep of that September policy decision where we in the market are expecting a cut. This report did check a lot of those boxes.
Okay, so let's dig into the numbers. Looking under the hood, do you see anything interesting there? Any interesting takeaways?
So I think the important part for the Bank of Canada's perspective is that sort of that lid on goods inflation, core goods inflation, which is stripping out those volatile components like gasoline, food prices, things that bounce around a lot on a month-to-month basis. Core goods has been running at about 3% over the last few months. That's coming off of an acceleration from the pandemic, but we saw that tick lower by 0.3 to just 1.7% in August. So that does speak to the fact that we're not seeing much impact from tariffs passing through to goods prices. We also saw a little more deceleration in shelter inflation. So for the last several years, we've had this large wedge between shelter prices, rents, house prices running away, and broader inflation. That gap is as close as it's been in 2 or 3 years' time now. Shelter inflation is back inside the target control range. But I think the most important takeaway for the Bank of Canada is just that those core inflation measures that it's most focused on do seem to be much more contained than they were over the last couple of months. So the two that the Bank of Canada pays most attention to are the trimmed mean and the weighted median. Those are both still running around 3% on a year-over-year basis. But if you just look at where that momentum is shifting, the 3-month rates of core inflation are quite a bit lower. They're 2.5% for the CPI trim and the CPI median. Other measures that the bank looks at, like the CPI-X or the X Food and Energy Index, they're actually even lower than that. So even though you are still seeing higher year-over-year rates of core inflation, that break in the 3-month rates does show that downward momentum is building. That speaks to inflation pressures stabilizing here, and with the economy already in excess demand, or excess supply, mind you, this does give the Bank of Canada a little more scope to respond to some of that weaker economic activity we've been seeing over the last 2 quarters.
So that goes right into our next question. Given that downward shift in inflation, how does this set things up for the Bank of Canada and its rate decision tomorrow?
Well, I don't think the inflation data needed to be all that soft for the Bank of Canada to cut rates here. We've been looking for a rate cut in September for some time. The market has largely been looking for a rate cut since that last jobs report, but inflation did still need to cooperate. If we'd seen a sharp rebound in those core inflation measures, that would have put some of the recent progress in doubt. That could have given the Bank of Canada a little more trepidation to follow through on those cuts. But with core inflation showing more signs of being contained, with those 3-month core inflation rates dropping, we think that will give the Bank of Canada a little more scope to respond to some of that weaker activity data. So We think that this report should help pave the way for a 25 basis point rate cut tomorrow. We think inflation really has been the key factor holding them back in both April and June and July. So after those 3 pauses, the bank's been giving some time for inflation pressures to subside. We think that, with the progress we've seen over the last 2 inflation reports, that, tomorrow now is the time to resume their easing cycle.
Okay, so given that backdrop, do you see tomorrow as a sort of one and done, or do you expect further rate cuts later this year?
We do expect further cuts. We think that tomorrow's cut will be followed by another move in October. And the bank does have a pretty well-established history of moving back-to-back, coming after a long pause like the one we've seen. Now, the bank, their estimate of neutral monetary policy, a rate which is neither stimulating growth nor restricting it, is about 2.75%. So even with a cut tomorrow, we would only be just inside what the bank calls accommodative policy territory. We think that they'll actually need to do a little bit more to really move the needle on growth. Now, we don't necessarily think that will be reflected in the messaging. They're certainly not going to take hikes off or cuts off the table, but it's not the Bank of Canada's style to pre-commit to anything. We think they do want to retain flexibility. They're not going to come out and say that we're cutting rates today, but we'll also go in October. So expect to see, an emphasis on taking decisions one at a time, incorporating all of the latest data. But by stepping off the sidelines tomorrow, we think that in itself is a pretty strong signal that the bank will look to continue easing rates in Q4.